Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have David Lafferty. He is the chief market strategist over in Natixis. Investment managers, we're going to talk about active management, how they do and can outperform, a refreshing subject to talk about outperformance with active managers. And we're going to take a look at our first chart here. Many active managers do outperform, as this chart indicates.
Yeah, I mean, I think there's been a real unbalanced narrative in recent years that passive is winning in all places and in all times, and that's really not true. It's certainly true that large cap US managers have tended to struggle, but we note, and we show it in some of our charts, that it really goes through phases, and there are a lot of different factors that contribute to periods when active managers outperform versus when they underperform. And it isn't this sort of simple narrative that active managers are underperforming everywhere. We frankly think in a lot of areas outside US equities, emerging markets, a lot of the fixed income areas, there is a lot of outperformance, varies by time period, and it's not this sort of one size fits all, active is bad and passive is good. That's the narrative we've really been pushing back against.
Yeah, it's really interesting because when you talk about large cap, it's really the same 5 to 10 stocks that are performing on the index, so it does make sense when you think about it in those terms. Now, when it comes to active management, it's not a zero-sum game. Tell us more about that.
Yeah, so there's an argument out there that's often made that active management has to underperform because of the fees. And it is true that alpha is a zero-sum game, but it doesn't really line up with the way that we measure active managers, which is basically we count how many managers outperformed or underperformed. We measure what we call a hit ratio. And so it turns out that while alpha in general, yes, it has to equal zero, it doesn't mean that it will fall equally across those managers. It could be dramatically skewed. So for example, some managers with a lot of assets and a lot of outperformance could be taking alpha from a fewer number of underperforming managers. And so it is true that alpha is a zero-sum game, but it won't fall evenly across those managers. So when we count hit ratios, 60% of active managers outperformed or 40% of active managers outperformed, that doesn't perfectly align with this zero-sum argument.
All right, now the million-dollar question is, how do you identify managers that outperform?
Yeah, it's never easy, but we also don't think it's this needle in the haystack exercise that you often hear. There are dozens and dozens of factors. I would suggest that one of them isn't just chasing past performance. We think consistency or persistency is sort of overrated in manager selection. But some of the things that the academic research tells us are fees do matter. If you buy a manager that tends to have lower active fees, that gives you a little bit of a leg up. Morningstar has some fantastic data on the effect of buying lower expense managers. You want portfolios to be active enough, so you don't want them to look a lot like the benchmark. If you can get rid of what people often refer to as the closet indexers, if you can get rid of those, that will improve your chances. And combined with that, managers who tend to have a longer horizon, that are more focused on real fundamental change and not so much the day-to-day noise. If you trade too much, you can rack up a lot of expenses. Mm-hmm. So if you focus on cost, sort of that longer-term horizon and portfolio differentiation, won't necessarily mean that you'll definitely find a manager that will outperform, but you really do improve your odds of finding one who can outperform.
What about the case where you pay for what you get? Does that apply really when it comes to active management?
I think it depends. Mm-hmm. Again, if your portfolio isn't highly differentiated, then you're paying active fees for a portfolio which has a lot of benchmark overlap. That's going to be tough. But yes, I think managers can produce value to warrant those fees. Again, the expenses can't be exorbitant, but good managers with a longer horizon that are sufficiently different from their benchmark should be able to generate enough alpha to outperform in the long run.
Are you seeing competitive pressures with indexing that's forcing active managers to really raise their game?
Yeah, absolutely. I mean, that's one of our core tenets is that, people think active versus passive. We really think active and passive. We think portfolios should have both. By no means are we anti-passive. The great thing that's happened is that the growth in passive has really raised the bar on active managers. It's caused us to go back and rethink portfolio construction, rethink your fees, rethink where you're spending your time. Is it more on distribution or other ancillary efforts, or is it really trying to find alpha, really getting into security selection? Frankly, the active management industry hasn't had that kind of pressure for many, many years, and in the last 5 or 10 years, the pressure from passive, I think, is really forcing active managers to kind of up their game.
Could be good for investors. That's for sure. Thank you so much, David, for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.